Thank you for joining us for our second quarter outlook. The title Spring Thaw refers to our belief that as the weather warms, so too will the U.S. economy, which is a direct contrast to what we experienced in the first quarter, which in capital market terms really was virtually the mirror opposite of what we thought would happen. Namely, our belief was that the economy would get stronger. It actually got weaker. With a stronger economy that we envisioned, we thought interest rates would rise, and they actually fell. In fact, if you look at how the S&P performed during the quarter, you can see that volatility really returned. As in January, of course, there were a number of emerging markets that caused investors to be nervous with what was happening there, followed closely by weak economic data emanating out of a very harsh winter here in the U.S. The market fell about 7% at its trough, started slowly rebounding, and then, of course, we had the concerns emanating out of the Ukraine and Crimea. In total, this really caused investors to behave sort of in a risk-off manner than a risk-on, which is what we think will happen for the year. We're not reversing our strategy by any stretch. Again, we think as the economy gets better throughout the year, things are going to actually pick up for the risk-on trade, and people will be well advised to stay the course with their allocation to equities and the underweight to fixed income. But nonetheless, clearly volatility has returned to the markets. Taking a look at where we think the economy is heading, the PMI we looked at the beginning of the year, and now we'll revisit that. When we last looked at this chart, we saw an economy here in the U.S. in blue that was really picking up, and expectations were that it was going to gather momentum. Well, the opposite happened here as the PMI, the Purchasing Managers Index, just plunged with the harsh winter. Now we've seen it start to rebound. We hope that this is really a sign of the begin in the thawing, where the U.S. is gathering momentum again, and that this harsh winter really was a short-term phenomenon. China, on the other hand, has stopped, it looks like, falling for the time being and is kind of basing here at a lower growth level. If you take a look at another indicator here of something that gives us at least some hope that we're right about our belief that the winter was really a one-quarter sort of setback, if you look at earnings on the S&P 500, actual earnings quarter by quarter in blue, you see that throughout 2013 we saw a very sort of steady growth in earnings, and now the expectations for the first quarter of 2014 is a distinct drop-off, and this really, we're going to find out more in the next month as all the companies report. But what happened really is 9 out of 10 economic sectors saw the earnings expectations revised downwards from about $30 down to $28. And if you look at consensus expectations for the balance of the year, the second quarter, third quarter, and fourth quarter, very nicely falls right back into the sort of pre-winter trajectory of earnings growth. So again, we're not the only ones that really believe that this was an anomaly here brought about by the harsh winter, taking about 1% out of GDP, and it's really going to come back in the back half of this year and get back on trend. Looking at the economy through another prism here, unemployment, clearly that's been a major concern of everybody, and certainly the Fed. Here in the green line, we see the headline unemployment rate, which has fallen to 6.7%. And until the most recent Fed meeting, which was Janet Yellen's first meeting, we have had a Fed that's given us a very specific target of 6.5% unemployment as the threshold at which, once that's attained, that they would consider easing some of their monetary policies. And we just have really had a suspicion that there was going to be more to it than that. And in fact, Yellen indicated that no longer was going to be the hard measure that they were looking at. In fact, they provided a lot more wiggle room for them and are looking at a lot more data. In fact, here in blue is a more broader measure of unemployment. This is called the U6, which takes the standard headline unemployment rate, which is known as the U3, and adds to it those people that are working part-time that would like full-time work, and those people that are unemployed that would also like to work full-time to the regular unemployment rate. And you can see, of course, there's a spread between the two. Historically, in the most recent couple of cycles, it's been around 4.6% difference. At the peak, the gap widened to 7%. It's narrowed to 6%, but this sort of unemployment misery index of sorts that the U6 portrays shows that clearly there's a lot of slack in the labor market, and it's going to be a much longer workout situation. Bottom line is the Fed is going to continue to be accommodative in our belief throughout this year and well into next. As far as our belief that interest rates are going to continue to rise, and therefore it's not going to be a good environment for interest-sensitive sectors of the market, here we've plotted in green the utility sector, the telecom sector, as well as REITs. And if you look at their behavior relative to interest rates in blue, which is the yield on the 10-year Treasury, you can see that they really move almost perfectly in opposite directions. When interest rates rise, the performance of those interest-sensitive areas fall, and vice versa. When interest rates fall, these equities appreciate. Now, in the first quarter, we saw interest rates falling, and therefore these asset classes doing well. We again believe that this is going to reverse trend here for the balance of the year, and therefore we're remaining underweight those sectors, not changing our attitude at all. As far as rates go, looking at the yield curve here, the yield on the across the spectrum, the yield curve on the 10-year began the year right around 3%. By quarter end, it had actually fallen to about 2.75. You see that interest rates really remained fairly unchanged through 5 years, but fell across the rest of the curve. Our expectation is that we'll have a shift up between now and the end of the year. The belly of the curve here, maturities between, say, 5 and 15 years, bearing the brunt of the move. Again, our expectation that we outlined 3 months ago is unchanged, believing that the 10-year yield will end the year at about 3.5%. So again, the most of the move will be here. Fed will still keep their zero interest rate policy in place, and inflation expectations won't go up dramatically. So our interest rate outlook remains unchanged. To wrap up, we expect the economy to rebound here back to the pre-winter trend with a more rapid pace of economic growth. We think that we'll see interest rates continue to trend modestly higher. This will provide a favorable backdrop for risk assets. This will translate into a very sort of, by historic terms, average return for equities, and higher rates will present a headwind that will cause bond investors to have flat to slightly negative returns. The risks that are out there right now, of course, remain China's growth rate, to see if they can arrest the contraction here in a material degree, and of course the specter of geopolitical event risk, primarily most recently in the Ukraine, but of course Middle East and the obvious hotspots still remain a concern. Thank you for your time and attention. We hope you have a great spring, and we look forward to visiting with you in the summer.